Welcome to this explainer. Today we're tracking a giant global game of dominoes. We're going to look at how a single, isolated geopolitical spark can set off a chain reaction that impacts absolutely everything around us. We're talking about the ripple effects hitting trillion-dollar tech valuations all the way down to the price of your everyday groceries. It is a fascinating and honestly kind of wild look at how deeply interconnected our modern world truly is.
Think about how this flows. Overnight military retaliation in the Middle East happens, and boom, it triggers an immediate, undeniable global shockwave. U.S. Central Command strikes over 80 targets. What happens next? An instant energy shock. Crude oil gets pushed up over 5% to $74.23. That jump immediately forces a yield spike, driving the 10-year Treasury note to 4.58. And right there at the end of that chain reaction, we see the ultimate market contagion, a direct threat to tech companies that are borrowing heavily to fund their massive artificial intelligence infrastructures.
To make sense of all this chaos, we're going to follow those dominoes exactly as they fall. We'll cover 1. The geopolitical catalyst. 2. Macro market contagion. 3. The AI reality check. 4. Micro-level realignments. And finally, 5. Real-world anomalies.
Part 1. The geopolitical catalyst. A world fractured. Let's start right at the beginning with that immediate spark in the Strait of Hormuz and the diplomatic fallout that set this entire thing into motion. Right now, we're witnessing a massive, stark, transatlantic split on the global stage. The U.S. is taking a highly hawkish, unilateral approach. We saw President Trump revoke Iranian oil sanction waivers and initiate those strikes on 80-plus targets. Meanwhile, European allies, they're actively executing an alliance realignment. They are aggressively seeking autonomy and deliberately steering away from U.S. dependency. It's a really dramatic shift in global policy.
And this growing fracture really took center stage at the Ankara NATO summit. Canadian Prime Minister Mark Carney unexpectedly emerged as the key player in a closed-door, high-stakes project. His ultimate goal? To reshape the Western alliance and steer Europe toward that exact autonomy we just talked about. The old alliance is visibly fracturing right before our very eyes.
Part 2. Macro market contagion, the ripple effect. So, with alliances shifting and crude oil surging over 5%, the macro markets felt the shockwave almost instantly. As those 10-year Treasury yields sharply surged 44 basis points to 4.58, prompting a massive tech sell-off across the board, we have to pause and ask a really critical question. Where is all that fleeing capital actually going?
Well, it creates this incredible funnel effect. At the top, you've got macro pressure from energy inflation driving up borrowing costs. Right in the middle, you hit a power bottleneck where those power-hungry AI infrastructure stocks take a massive hit. The result? A literal capital rotation. Money is actively shifting out of semiconductor indices and flooding directly into the old economy, specifically healthcare, industrials, and financials. It is a textbook flight to safety.
Part 3. The AI reality check. Bulls versus bears. Let's look at how this macro contagion builds into a seriously harsh reality check for the once untouchable AI sector.
The sheer weight of Wall Street's sky-high expectations is literally crushing memory giants right now. Just look at these numbers. South Korea's Kospi index, which is heavily weighted by these tech firms, has officially entered a technical bear market, down 20% from its recent highs. Samsung Electronics dropped nearly 13%. And get this, that is despite a staggering 19-fold rise in operating profit for the June quarter. Insane, right? SK Hynix also fell 6.1% just ahead of its US NASDAQ listing. The expectations were just way too high to meet.
But hey, it is not a complete collapse. It's more of a high-wire balancing act. On the bear side, sure, you have the Asian chip sell-off, the Kospi bear market, and escalating US-Iran conflicts driving energy inflation. But the bull case is solidly anchored by an improving ISM manufacturing index signaling EPS growth. And critically, there's a structural buy happening. 76% of large-cap growth managers are actually underperforming their benchmarks right now, which means they're essentially forced to buy these dips just to catch up. Plus, imminent catalysts like new AI models from OpenAI and SpaceX are keeping those structural bulls very engaged.
So the trick here is finding the real corporate moats hiding in all this market panic. Take Micron's brilliant defense strategy. They've built themselves a $100 billion guaranteed revenue floor. How'd they do it? Through 16 long-term supply agreements, including a massive new strategic deal with Ford Motor. These contracts now make up 40% of Micron's total revenue. That provides a huge margin moat, even while the broader semiconductor index is facing extreme volatility.
Part 4. Micro-level realignments, diverging valuations. As the macro dust starts to settle, we're seeing some truly wild, polarizing realignments at the micro-corporate level, especially between the absolute biggest names in tech.
We're actually watching analysts crown a completely new tech king. When you put SpaceX and Tesla side by side, the divergence is just stunning. SpaceX is now boasting a $3.2 trillion valuation, which absolutely dwarfs Tesla's implied $1.2 trillion. Wall Street sentiment is giving SpaceX a 75% buy ratio, compared to Tesla's 40%. And if you look at valuation multiples versus 2027 sales, SpaceX is trading at a whopping 45x multiple, while Tesla sits at just 15x.
But hold on, it is not all clear skies for this new king. Trivariate Research points out a key insight they call target dispersity. They warn that SpaceX's wildly varying analyst targets, which range from $165 from New Street all the way up to an astronomical $800 or a $10 trillion valuation from Raymond James, is actually a massive red flag. Historically speaking, that kind of wide target dispersion usually bodes really poorly for future stock performance. The market basically just can't agree on what the company's actually worth.
Part 5. Real-world anomalies, from Twinkies to taxes. Finally, let's step away from the trillion-dollar tech valuations for a second. Let's trace this global instability all the way down to some truly bizarre, everyday consumer anomalies. Let's look at the anatomy of a massive food industry misstep. Back in 2024, during a pandemic-fueled snacking supercycle where the market hit $65 billion, Smuckers made a huge $5 billion acquisition of Hostess. Yeah, the makers of Twinkies. But fast forward to 2026, and consumer habits have rapidly normalized. That aggressive bet has tragically soured into long-term value erosion, leaving Smuckers holding an overpriced legacy asset in what analysts are literally calling a sugar crash. And then there's the extreme friction hitting everyday household budgets. Major insurers in states like Washington are requesting a massive 28% premium hike for the Affordable Care Act for 2027, and remember, that is compounding on top of a 35% increase from the year before. Over in Illinois, we're seeing the exact same pain, with 15% hikes compounding on previous 28% jumps. The cost of care is just compounding at a totally unsustainable rate for regular families.
Meanwhile, over in local real estate, policies are actively being weaponized. New York is pushing a pied-à-terre tax targeting ultra-wealthy non-primary residents. The logic goes like this. If a home's value exceeds $5 million, isn't a primary residence, and isn't occupied by a family or a tenant, bam, a heavy tax is applied. This even prompted Citadel CEO Ken Griffin to threaten pulling a massive Midtown office tower redevelopment project in direct retaliation against the city's mayor.
And amidst all this fractured, totally unpredictable market chaos, some absolute anomalies are just thriving out there. For instance, despite discontinued production, enthusiastic demand has driven the resale value of refurbished classic Land Rovers up to $170,000. And then consider the Messi anomaly. Lionel Messi, widely considered the greatest global soccer player, actually set a new record for missed penalty kicks. Yet despite all those misses, Argentina still survived to advance in the World Cup, while the US was eliminated. Sometimes, the data simply defies all logic.
So when you take a step back and look at the whole shebang, the connections are pretty staggering. From a military strike in the Strait of Hormuz, rippling directly down to a 45x multiple on a space company, and then a 28% hike on your healthcare bill, the cascade is continuous, deeply interconnected, and wildly unpredictable. It leaves us with one critical question as we wrap up this explainer. Looking at all this data, which domino do you think will fall next?